Hello, everybody. Welcome to the November edition of CapWealth On. I wanted to just take this opportunity to give you a real informal look at how we are thinking about the financial markets, an update on the GSEs, and then finally I want to close with some comments about the litigation that we went through with the Securities and Exchange Commission. So that as a backdrop, why don't we just jump right into talking about the financial markets. To say that we're surprised by what's happening would be kind of an understatement, and yet we always predicted that we were going to have this massive reversal in interest rates and the financial markets. You just never know how it's going to occur and how quickly it's going to happen. We have seen the fastest increase in interest rates since 1937. It has been the worst year for investors that follow a 60% stock, 40% bond allocation since that same time period. And yet, this is where we thrive. We play defense. If we were an NFL team, we'd win games through defense. It's not offense. It's, rule number one in investments, as Warren Buffett says, is don't lose money. Rule number two is remember rule number one. And so as we go through and we look at some of the strategies that we've employed this year in preparation for this, we'll keep that in mind. And it goes all the way back till 2020, at the start of the pandemic. Grant and I spent a lot of time, he was just new to the firm at that point, in really formulating policy. We had the belief that the pandemic would end and that some of the speculation surrounding the pandemic was inevitable, and it was reflected in people's attitudes. They were extrapolating non-recurring events. What do I mean by that? They were thinking that everybody was going to work out in their basement forever, and they'd never go back to a health club, to believing that they would never travel again, to any number of things that became dominant themes in the crisis that was part of what we know as COVID now. So it didn't take long for that to start to unravel. And by July of last year, everything had peaked. And we were seeing some of the speculation that was associated with that in the pricing of a lot of different companies, and certainly how the bond market investor was being penalized for just being a saver, trying to be a conservative investor. They were paid virtually nothing for their efforts, while it seemed like the speculators and that old saying, it's hard to watch your neighbors get rich, everybody else was getting rich. Well, that's reflected now in the reversal of what's happened this year. I've got some statistics in front of me. First one is most obvious. The average bond market investor has lost 15% this year because of the tremendous rise in interest rates. That's bad news. And the rise in interest rates has brought the economy, I think, pretty much to a halt, and that we are now in a recession. It's a question of how mild or how extensive it's going to be. The silver lining in that cloud, and I always look for one, is that we are reestablishing things the way they should be. The natural order of things is that investors should be rewarded, not penalized. Speculators should not be rewarded for borrowing money and speculating on everything from crypto to investments in companies to real estate, all sorts of assets. And what do I mean by that? Well, you take a conservative elderly investor that keeps a little more cash around than they ordinarily would, say $200,000, $300,000, $400,000, that they keep at their bank in CDs and other financial instruments of a short-term nature. And we've encouraged our clients to do that because we didn't have a good alternative for them during the period where interest rates were zero. Well, now they've gone from, take the example of a $300,000 CD or deposits in a bank where they were paid less than $3,000 a year. Now they're being paid $12,000 a year. So the stimulus checks that went to speculation in 2020, well, that $9,000 stimulus check is going to investors, savers, conservative people that will now start generating a rate of return on their money. Conversely, let's take an example of what has happened to a typical commercial real estate project. You know, a commercial real estate project that had a valuation of $165 million currently, that is trying to, say, put financing of $130 million on it. In less than a year's time, the increase in the interest expense that they're experiencing is $417,000 a month. Now think about that. That's $417,000 a month. It's being redirected away from the investors in that real estate project. It's not going for tenant receptions. It's not going for tenant improvements. It's not going for additional amenities in the building. It's going back to those savers that I talked about earlier. And so what happens in that kind of environment? Everything's revalued. So that property is not worth as much as it was a year ago because the cash flow from that property has been impaired by more than a doubling of the interest expense. And every one of these projects has some level of leverage. Every private equity fund typically has some level of leverage. And that's what gets people in trouble. Because when you have an asset that declines in value at the same time that your carrying costs, your borrowing costs go up, bad things happen. That's what's happened in the crypto market this week. That is what is happening in commercial real estate projects. Unfortunately, that's what's happened the average prospective American homeowner. They've seen their carrying costs from a mortgage, they've seen them almost double in the last 12 months. In fact, I saw one article that said that financial security in this decade may be defined by when you got your mortgage and what rate you got your mortgage at. So we've seen mortgage rates go from 2.75% to, in some parts of the country, almost 7% now, with higher down payments and more scrutiny is being placed on the transaction and the creditworthiness of the borrower. So all of that isn't a great background other than for those that have played defense. So when we look at our accounts at CapWealth, and I review all the accounts virtually at some level every single quarter, we don't have accounts that are even close to the losses, for example, of NASDAQ, which is down 28.4%. Our declines in value are somewhere at the low end of 4% to an average of maybe 12%. The S&P 500 is down 17% this year. We've got, the similar type declines in the Dow Jones Industrial Average and other inflation-related indexes. So while we're never pleased with any results, no matter how good they are, we feel like we've been very, very well prepared, much better prepared than we were in 2008. And that's always been my goal since the lessons of 2008. We came back very quickly in 2009, partially because of the recovery everyone had. This time, I wanted it to be different. I wanted it to be better than what we experienced 14 years ago. And I think we've done a good job with that, of being cautious. You're going to see some new additions to your account over the next 12 months. The bond market is back, and we can get between 4 and 8% on the most conservative U.S. Treasuries to some reasonably high quality corporate bonds. And so we will start mixing in, we already have with U.S. Treasuries, we've started mixing them into accounts. We remain focused on basic goods and services. That's reflected in how our asset mix changes from time to time. So we look at what our top 5 holdings are. And it was no accident that Berkshire Hathaway, Warren Buffett's company, Charlie Munger's company, that's our number 1 holding. It's the first time that's ever happened. A year ago, it would have been Apple. And so it was also no accident that I think it was about 2 weeks ago, Berkshire Hathaway became the most valuable company in the world again compared to Tesla. And so you have this changing of the guard, shifting. I still remember when Warren Buffett was cutting his losses, moving to cash, building for the moment in time that we have right now. And there he sits in a very opportunistic way with billions and billions of dollars of cash ready to deploy to some of these distressed assets that are now, part of the landscape. So we feel like he's a great partner to have, and we enjoy that relationship, and we'll probably continue that for many, many years to come. So that gives you kind of a sense of where we are on the investment side, just to kind of look through some of the companies that we've added this year. Campbell Soup was one of them that we added back in December of last year. It's got a positive, great return for the year. Something as obscure as Hostess Brands, which we added in a small way in 2020. It was very difficult to get people to understand that and go along with it during that time period, because it wasn't very sexy, and Twinkies don't exactly evoke a vote of confidence other than those of us that grew up on them in terms of the kind of company you want to own. But the results can speak for themselves. The stock has gone from $12 to $28 and is up well over 20% this year. So you can still find value in a lot of companies. CVS Healthcare is one of our large holdings now. Great dividend yield, considered a value stock, essential service. We're excited about the prospects and what they can do as part of the evolution of cost containment in healthcare. Another company that we've held for quite a while that didn't perform very well, that has done very well this year, is Gilead. Gilead has a tremendous positive return this year in the 15+% range, had a great dividend yield, has a great dividend yield currently. It's the kind of company we like. In the areas that we made a mistake, and I'd say made a mistake because we were early, I still believe in the thesis longer term, was a company like Intel and Ultra Clean and Hymax. We recognize and still believe that our dependence on semiconductors, which basically power the world right now, and the shortage related to that, and the geopolitical risks of our only source of supply coming from Taiwan, was really a call to arms, and it became a national defense priority to correct that deficiency in our supply chain. And so Congress enacted legislation that will enable companies like Intel and others that are spending billions of dollars on creating domestic sources of supply, those billions of dollars, with the help of, for example, Senator Haggerty, who's taken a leadership role on this, he streamlined the process of getting these plants up and running much, much quicker. And that was one of the big problems because, technological obsolescence occurs about every 3 years in the chip industry. And you can't delay the permitting process for 4 to 5 years in order to do that. So he was very helpful in fast tracking that whole sector of an industry. So we're very grateful for that. We don't like the performance, but we have a great dividend in those companies. We'll be patient with them. We have done tax loss selling, so we've created some economic value and cut taxes for someone. But in the long run, in the next 3 to 5 years, we're very positive about that sector and those investments and the quality and balance that they'll bring to your account. Starbucks is another example. We've got a whole group of companies. We've got Pepsi, we've got Coke, we've got Starbucks that anchor kind of a consumer orientation that we feel is very resilient. They're global companies, very defensive, and they all have good dividend yields, and they've increased their dividends this year as well. Finally, I'd say that the other thing that pops out in that top 5 holdings that we have and some of the income that we generate from that, two of our largest holdings are Chevron, which I think is our 2nd largest holding now, and Williams, which is either our 4th or 5th largest holding. Did we predict this shortage of oil, gasoline, other problems related to the energy sector with geopolitical instability? No. We gravitated to those companies because they represented great valuation. We knew and felt like there was going to be a shortage because of Biden administration policies that artificially restricted the development of fossil fuels at a time when we still needed to develop more as we transition to this green economy, and that calculation would drive the price of oil and other fossil fuels upward. Well, it has, and those 2 investments, including our recent investment in Devon Energy, have added both substantial dividend income but great appreciation, which has offset some of the other losses in this revaluation of the market. You got to have things that are going up when everything else is going down. That's the simple process with all of this. So it's important to keep that in perspective, and it's also important to note that we're really somewhat excited about the opportunities that this type of environment creates for investors like you, investors like us, as we approach the market conditions. And so we're ready. We're evaluating things on a daily basis. I've got a great team led by Grant and Drew and Michael's our newest hire, graduated with a finance degree last year. He's studying already for his chartered financial analyst designation. We've got a great team of people that are helping us guide both our advisors and how they speak to you and how they explain things to you, and at the same time help me implement policy. So very happy about that. That wraps it up. Thank you. If you have questions, this is the time to really get in there and ask. And we're going to be very, very proactive as we continue to respond to these events and opportunities. We look at them as opportunities as they unfold over the next year. I believe that we will be dealing with the inflation problem and higher interest rates at least through the first half of 2023. I don't think there's any quick fix for it, and it's going to be painful for a lot of Americans, and our commitment is to not make you one of them. Thank you, everyone. We look forward to sharing another edition, our December issue of CapWealth On, early in January, and wish you all a happy new year, 2023.